Good afternoon, coastal Southern California. It's Jennifer Tim here, real estate wealth advisor, licensed in both California and in Oregon, and back this week for your midweek market brief where smart money watches the market. So let's get going with what has been going on at the national level. So, our national outlook. So, first, we'll start off with a national economic snapshot because obviously national economic policies and trends are definitely influencing real estate. So, our labor market is cooling. Job openings dropped to 6.5 million, which is the lowest since 2020. Private job growth slowed sharply. January hiring came in well below expectations. Layoff activity rising in some sectors, though overall unemployment remains moderate. Mortgage rates hovering in the low 6% range, and we'll have a look at where today's rates fell. Relatively stable week over week. Inventory is up 10% year over year, but growth is slowing. And again, this is that national outlook. It could be very different in your own neighborhood. National home prices are mostly flat. Definitely regional differences are widening, and we'll look at some of that. Market balanced nationally, but leverage varies significantly by region. As always, real estate is always local. So, for homeowners, what does this mean at the national level? So, national prices are steady, but local markets are moving differently. Equity is holding in many areas, especially tight supply regions. Days on market are longer, pricing right matters more than ever. And more sellers are pricing strategically upfront. There are fewer reach prices, which is a good thing. Northwest and Northeast and Midwest are the strongest seller leverage than the South. And your zip code is more than likely greater than the national headline. So local data wins, which is why it's so important for us to look within each local area. For buyers, what does this national outlook mean? More negotiation power is showing up in many southern markets. Price reductions are more common in buyer-friendly regions. There's more time to choose that right, perfect home. In slower markets, less urgency, more options. The rates near the low 6% range are definitely helping buyers re-enter the market. And we're hearing that from our mortgage lenders as well. All those mortgage apps are definitely on the rise. Wins with terms. So ask for credits, repairs, or rate buy down. So basically it's that negotiation and crafting an offer which makes sense based on the needs of the seller and what's happening in that local market. Focus on value pockets where inventory is building. For investors, national stability equals regional opportunity. Market selection matters, definitely. So South and parts of the West may offer better discounts and concessions. Inventory growth markets can mean softer pricing and better entry points. Returns matter more than appreciation in this phase of the real estate cycle. So making sure you know what those numbers are for you. Repositioning window, trim underperformers and optimize your portfolio. And then underwrite conservatively. Rent, insurance, taxes, and vacancy. It's really important to put all those numbers together. And of course, we can help you with those numbers. Our mortgage rate watch for today from Mortgage News Daily. Our 30-year fix was sitting at 6.14%. 15-year fixed 5.71, jumbos just over 6 at 6.3, and our 30-year FHA and VA, of course, are under that 6% range. So they headline today, modest increase in rates is a win, and here's why. So let's read further. Mortgage rates moved 0.03% higher today on almost any other day. This would be a bit of a bummer, but in today's case, it's a victory. And this is copied directly from their website. There was a lot of potential volatility in the underlying bond market heading into the day due to the scheduled release of the big monthly jobs report. In addition, rates have taken a bit of an anticipatory lead off ahead of the data, or at least it looked that way. The implication was that a strong jobs report would come as a surprise and require a rapid correction towards higher rates, possibly significantly higher. Truth has been stranger than fiction. The job count crushed expectations, and the unemployment rate fell to the lowest level since September. These numbers should have caused more damage than they did, i.e., we would not have been surprised to see mortgage rates jump twice as fast as they did, at the very least. So, what accounts for this welcome display of defiance? That's unclear. It's a phenomenon that's playing out in the broader bond market and not just in the world of mortgage-backed bonds. Either way, we'll take it. So let's enjoy the 6.14% where we are, and we'll see what happens tomorrow. Every day it changes. So our National Smart Money Insight. And this is basically what all this information means for you. Don't follow the national market. It is so important to stay educated about your market, because honestly, from one street to the next, one neighborhood to the next, whether you have a view property, whether you're on a single loaded street, all of that impacts the market data for your home. So there's the tight markets, which is the Northeast and the Midwest, versus negotiable markets, which are the South. So definitely we're seeing some differences in what is happening across the country. Price plus time on market tell the truth about leverage, always. Plan moves proactively while conditions are stable, not in a rush. Homeowners protect equity with smart timing and pricing, and buyers negotiate confidently where inventory is rising. And that's why we always recommend that you work with a real estate professional like myself or anyone that you know. Truly vet them before you work with them, because they need to understand what's happening with the market. They need to be market experts. Investors prioritize, it's that time of the afternoon. I need another cup of tea. Investors prioritize performance, so that cash flow and risk over the hype. And we went through a couple of sessions ago how we calculate those numbers. And of course, we are always available to assist you in that regard. Looking locally, Capistrano Beach is down slightly for that market action index. It's down to 36. Median list price down. It's sitting at just under that 3.4 million. Price per square foot, 1,102, which is down. Inventory's up to 15 homes. So we're really not talking about a lot of inventory. So just one listing sold, coming onto the market, relisting, price adjusting, really can impact these numbers. Median days on market is up to 105. So this is a timing window market. Inventory is tight, but price momentum is soft. Sellers must price precisely. No aspirational pricing. No, I wonder if, let me test out the market, because your property is just going to sit. Buyers should negotiate confidently before that market action index turns upwards and prices firm. Remember, we're entering into that spring market. Moving on to Dana Point, our slight sellers advantage remained the same at 35. Our median list price is down to 4.595. Price per square foot, 1,706, is up slightly. Inventory is up slightly, 37 homes. Median days on market, 91, is unchanged from last week. So luxury plateau is forming. This is a strategic repositioning window. Sellers should adjust early, not reactively. So again, listen to the advice of your real estate professional who you have hired to help you. They can show you the data, and that'll help you decide what you need to do with your pricing. Buyers leverage concessions while sellers test price ceilings, because we know everybody wants the highest price possible for their home, and often sellers think we're back in the market of yesteryear, which we're not. Right now, we are where we are, and of course, things could change in the future, and they will. San Clemente, our market action index is 41, which has gone down slightly. Median list price is down to 2.35 million. Price per square foot is down slightly, $866. Inventory, 65 homes on the market, and our median days on market has come down to 77. So this is balanced strength, not overheated and not weak. Move up buyers can transition here without extreme competition. Investors should prioritize properties under 2 million where absorption is strongest. And our San Juan Capistrano, our strong sellers market is up to a market action index of 50. Median list price has gone up slightly to just under that 2.6. Price per square foot down to 763. Inventory is unchanged at 27. Median days on market is unchanged at 63. So supply is tight enough to absorb any weakness. Sellers who price correctly will capture momentum in San Juan Capistrano, and buyers waiting for big discounts may miss the rebound if that market action index climbs any further. So don't look for any dramatic crash in the market. None of that is on the cards based on the economic data that is available. So if you are in one of the other areas that we cover, watch your social feeds for the market information about those areas. And we're going to move on to our global perspective this week. And I thought we would look at our neighbors because I did some searches to see where investors are really looking, and Canada was actually number 2 on the list. Surprisingly, India was number 1, and I'm going to cover India in a future session because I will, within the next 2 weeks, be meeting with some of our Keller Williams partners from India who will be at a conference that I will be attending, and I'll be able to share some investment opportunities in India after I've had that conversation with them. So Canada, stability in a shifting global market. Rate relief tailwind, easing monetary policy is improving mortgage affordability and buyer confidence. Canada is emerging as a stability play amid global economic uncertainty. So it's creating an investor safe haven. Now, you've got to understand there are chronic supply constraints. So the major metros, Toronto, Vancouver, Calgary, continue to face long-term housing shortages, and population growth engine, strong immigration levels are supporting housing demand and rental absorption. So it really depends on what your intention is for investing or considering investing in Canada. Resilient rental market. Tight rental supply is keeping upward pressure on rents in key urban areas. Construction lag. Development remains below what's needed to fully close the housing gap. So that global capital interest, international investors continue viewing Canada as a transparent rule of law market. So it really depends on what your portfolio looks like and what your intent is with investing in Canada. But definitely has some options. Our smart money inside Canada isn't the fastest growing real estate market, but it may be one of the most defensive and durable. In a world of volatility, markets with population growth, supply constraints, and policy stability tend to outperform over the long term. So it's one of those safer bet environments to be in. So if you are looking at changing up your global portfolio or expanding and investing, please don't hesitate to contact me. I am a certified international property specialist and have many Keller Williams partners in Canada who can assist you, and we would work together with you to help you achieve your goals. Our wealth building insight, and this information came from an article that was put out by the National Association of Realtors, and it's all about the wealth building opportunities that real estate offers. So we've kind of broken it down into homeowners and investors. So we're going to start with homeowners. Why should we consider investing in real estate, whether it's your primary residence or an income property? So your home is still building wealth. 73% of US metro markets posted year-over-year price growth. Most homeowners are still gaining equity in their home. 147,000 in new wealth. The average homeowner has built $147,000 in housing wealth over the last 5 years. That's not a bad return. I like that number. And of course, very market specific. Price growth is slowing, but it's not reversing. So slower appreciation creates stability, not loss. And it's ideal for planning, not panic. Again, it's all part of developing a real estate wealth plan. Affordability is improving. Mortgage payments are down 5.7% from last quarter, easing pressure for move up or downsizing decisions. So we're starting to see that movement happening in local markets and of course nationally. And then regional resilience. The Northeast and Midwest continue to show steady growth, ideal for long-term equity preservation. So for investors, what and why should we be investing in real estate as a business? So market shifts create opportunity. About 25% of markets saw price declines, especially in high supply areas, which is ideal for repositioning your capital, getting in now so that you can then watch that appreciation happen. Equity does not equal performance. Appreciation alone doesn't mean your property is performing well. It is really important to look at all those numbers. That cash flow and efficiency matter more now than ever. Rents, rates, and reality check. With moderating prices and improved affordability, now is the time to reassess cap rates and returns. And again, that's why we're here. This is what we do all day, every day, is assist our clients by doing an equity analysis, calculating just a napkin test, what their capital gains liability could look like. What are the strategies to avoid paying capital gains tax? And then really looking at cap rates and cash on cash return for any of your investment properties, and then helping you self-discover what you do want to do with your equity next. So still pockets of strong growth. Some metros are posting 8 to 13% annual gains, proving opportunity still exists with the right strategy. I am connected to 1031 experts around the country, real estate agents who specialize in working with investors who are fully aware of what those opportunities are like in their local markets. Passive is obviously much better than active for many investors. Investors are increasingly exchanging management-heavy properties for more predictable income options. Those 3 a.m. phone calls kind of get to you after a while, and we can help you with that. So our wealth building insight, what this really means for you. Equity creates choices. Whether you own a home or an investment property, growing equity gives you options, but only if you plan ahead. It's so important to be strategic. This is an important, whether it's your primary residence or primary plus your investment properties, this is really, these are important assets that you need to plan how they're going to work for you as you progress down life's journey. Now is a planning window, slowing appreciation and improved affordability. It's a strategic moment, not a reactive one. So ask the smart questions. Is my property still working for me? Is my equity aligned with my long-term goals? Am I building convenience, income, or legacy? Smart money plans, it doesn't guess. So the most successful homeowners and investors review performance, reduce risk, and plan proactively. And that's where we come in. We are your partner in this journey together with your financial advisor, your CPA, and anyone else that you have advising you. So legacy is built by design. Real estate wealth isn't just about owning property. It's about how and why you own it. So let's talk strategy. DM me, email, book your complimentary equity analysis, and let's craft your 2026 real estate wealth plan. And if anything in today's session, Midweek Market Brief has sparked any questions or inspired a next step, I would honestly be so honored to connect. This is how you can get hold of me, many different ways, and it would be my honor to assist you. And just a quick disclaimer that the material is provided for general information purposes only, should not be construed as investment tax or legal advice. We do obtain the information from credible sources, but cannot guarantee or warranty its use. Past performance of any market results, no assurance of future performance, because we know things change every day. You should consult your own legal, financial, or tax advisor and verify all information to your satisfaction prior to taking any action. Thank you so much for tuning in on this Wednesday, our second Wednesday in February, and I look forward to seeing you next week.